This conference will now be recorded.
This video is going to cover the input process to create a premium financing case. And here are the specifics. Basically, these are the case assumptions for this sample case. It is going to be a premium financing case. The insurance product that I will be using in this example is a whole life policy. You can certainly use IUL, VUL, or whole life. This one happens to be a whole life policy. And this is going to be a premium finance policy for retirement planning purpose. So the insured individual is the policy owner. Okay, so it's not a business or a trust that's going to be owning the policy, rather the individual. And then he is going to be the borrower of the premium dollars from a bank. The loan interests are assumed to be paid annually, so they are not accrued. And the bank loan repayment is designed to be occurring in year 18, okay? And this is going to be split. It's a split payment. Half of the payment comes from the insured's own funds, and half of the payment for the loan back to the bank comes from a withdrawal or loan distribution from the policy. The policy is going to have additional income distribution, which coincides with the retirement phase of the client. So there's going to be a first withdrawal and then also additional loans, okay? And the unique part of this case is that I will include a loan interest reserve account and a loan interest and balance reserve account as part of the illustrations. So there will be additional reports. And the goal is to show you how the whole thing is put together in the InSmart Premium Financing System. The policy that's going to be used look like this, okay? It is a whole life policy. Annual premium is $234.75. So this is a large case, 15 payments, and it's going to obviously produce your cash value and death benefits. In year 18, which is designed to be the year of loan repayment, there is a $1.7 million loan coming out of the policy. This is the first distribution from the policy, and it is used to pay back to the bank, okay, for half of the total loans to be paid back to the bank. And additionally, starting year 23, as of age 66, there are going to be additional income distributions. So these are additional loans from the policy that are supposed to be providing tax-free retirement income to the insured. And this is really the objective of this policy, to get a large policy funded, which will produce a nice retirement income, okay? And you get the cash value, surrender value, death benefits. So these are what we call a source data provided by the carrier. And step number one, you need to get these relevant data into the InSmart system as a source data. Okay, that's step number one. And I've already done it. I basically cut and paste these columns that I need into the premium financing system as a source data. Once you get the basic insurance data, the source data in, then you load the source data in the premium financing system, and then you can set up the premium financing input. So you launch the InSmart system from this shortcut which is an icon on the computer desktop. So the program that will be used is the premium financing system. I click on this to launch the program. And I will be doing a new client's case. So this is the option to select from the start menu, create new client workbook, and click OK to go to the next step. And the guy's name, I will call him Jim Reed. Okay, just the name of the insurer. It's a made-up case. Okay, so after you name the client workbook, you come to this screen, which is called the proposal description. And what I want to use is this module, which is premium financing policy owned by an individual. So if I'm not doing a trust-owned estate planning case, but a retirement case, so this is the module that I want to use. However, very, very important thing to remember is you need to make sure you load the right source data. Okay, before you get to do the premium financing input, you need to load the source data. And look here, I've got a pack life policy, which is nothing to do with the case that I want to do for Jim Reed. So how do I change it? This is left over from the prior case that I did. All you need to do, you click on Create New, this button, to change the policy to the correct one. So you click on Create New and watch what comes up. You are now in the source data storage file area. And it is not this case that I want, but rather this one, okay? This is a whole life policy, and you can review it to make sure you pick the right one. See, this is $234,075 premium for 15 years, 7.5 initial death benefit, and you see in year 18, $1.7 million loan is coming out to pay back half of the loan to the bank, okay? And the reason we split the payment, half with the money coming out of the policy and half from the insured's own funds, is because this policy has no way the ability to support the entire 3.5 million loan in year 18. Because if you look at the PDF, in year 18, the year before the loan repayment, the cash value is about $3.8 million, and the entire loan cumulative premium is 3.5. So it's not possible to rely 100% on the policy cash value. Sometimes you may let the policy grow longer, or you fund it with even more premium, but we're working with this policy right now and see if it can somehow work, okay? So the solution is to take out 1.7 million, and you still have about $2.2 million left, and you let it grow for maybe 2 or 3 or 4 more years. And at age 66, when he retires, it's still able to provide this kind of retirement income. But an additional $1.7 million is going to be coming from the insured to pay the other 50% of the loan back to the bank. This is the case assumption, okay? So here I have already added the insurance source data in the source data storage area, so it is ready to be used, okay? Right? This is the same policy, which is now in the InSmart system as a source data, which were copied and pasted from the PDF from the carrier. So I picked this one. It's highlighted blue, which means it's selected. And then you click on OK to load the source data. And you see here, now it's changed from that Jim Rydell Pac Life policy to this one. And again, over here, you can also double check and click on the review button to bring up all of the data. Okay, so this is the right policy for Jim Reed. And we're going to now do the premium financing input as a retirement planning case with the policy owned by Jim. Okay, so pick the right module. It's located under premium financing, this one, third option. So click on OK to move to the next step. Now you are in the real input tab area for a premium finance case. Okay, step number 1, basic data, and then you go through all of these and then you get your reports. This is the process of the input. So basic data, how many years do you want to illustrate? You can illustrate for 50 years until age 100 or beyond. So it's a user input. And the insured is 44, okay? See, source data is, you're able to bring it up to look at it, even within the input area. Anywhere you see source data, you can click on the review and it will bring it up, okay, these tables. And he's 44, and for this example, I want to run this until age 100, and that means it's 57 years. I don't want to go beyond age 100. So instead of 60 years, I do 57, okay? And the name of the borrower is Jim Reed, okay? The name of the lender, I just call this ABC Bank, okay? You could name your own bank's name. So I refer to it as a bank rather than a lender. This is just the name of the lender, okay? And the guy's tax bracket, I will use 40%, which is fine. He is in a high tax bracket, okay? So basic data is done. Next, we come to loan details. And the question number 1 is right here, okay? Loan repayment from sources other than policy values. This is an input that you need to deal with if you want to activate loan reserve accounts. See over here right now, it's grayed out. And it is grayed out when it's irrelevant if all of the loan is going to be paid by a withdrawal or loan from the cash value of the policy. So if the insurance policy is going to be providing 100% of the money to pay back the entire loan back to the bank, you don't need these loan reserve accounts, okay? This is only used if you want to show to the client how much annual levelized contribution he needs to commit to if he wants to pay some of the money back to the bank. So if the policy doesn't have enough money, or for whatever reason he has enough money that he's going to pay off the bank loan in the future. So this way he preserves 100% of the money in the policy, and that's going to provide bigger death benefit and probably bigger retirement income. So, but in this case here, I am going to check this even though the policy is going to provide half of the money to pay back the bank loan. So you need to make sure, okay, even it says, assume the cumulative loan is paid from sources other than policy value. Here, it's half of the loan, okay? So you do need to check this. And when is it supposed to happen? It's supposed to happen in year 18. So you need to type in the year, okay? This is the timing of the payback of the loan. And where is this money coming from? From policy owner. You need to check this to activate this input tab, okay? So you check this box and you select this one. The money is going to be paid, is going to be coming from policy owner, his own funds. Okay, so this is under loan details. And down here, these other input is very simple. It's, you know, if the bank or lender charges additional fee on top of the interest, you add those here. If they don't, just ignore it, leave these blank. Second is loan collateral details. This is actually a report option. It kind of comes by default selected, but you don't have to include it. If you don't want loan collateral numbers showing up on the report, you just deselect it. Majority of the time, probably lenders want you to show the additional collateral. So you check the include, okay? And then you need to, again, select the name of this collateral. So I call this additional collateral required rather than letter of credit. So I pick this one, okay? Next is how much additional collateral is going to be required is going to be based on a couple of input. So the calculation is going to be depending on the input. So sometimes some lenders may be more conservative, and they will say, we don't allow 100% of the cash value of the policy to be used as collateral. So they may say only 95% or 90%. But here I am going to say the lender allows 100% of the cash value to act as collateral on the loan. Okay, so again, this is a user input depending on the lender requirements. And then down here, how much is the shortfall? How much of the shortfall needs to be put aside? How much additional collateral needs to be put aside to secure the difference between the loan and the cash value? So in the earlier years, especially, I would say in all of the cases, if 100% of the premium is borrowed, in the earlier years, the cash value is going to be lower than the loan principal. So some bank or lenders will require not just 100% of the difference, but maybe more. So again, this is for the more conservative or more strict lenders. Here I am going to be using 100% needs of the difference. So whatever shortfall, whatever amount that's lower, that's not enough to cover all of the loan principal, needs to be put aside as additional required collateral. That's what these two inputs are about. There are more complicated, detailed input options available. If you need to deal with this part, you need to select this, okay, or this. Calculate, then this part becomes available. But here I am using the simple input, assuming, these kind of numbers. So we take care of the loan collateral input. The next one is this one. This may be the most complex input tab. It deals with payments, interest, and cash flow, okay? And then look on the left side here, there are actually multiple subtabs too, okay? So depending on which tab you select, it's going to give you different input field. So question number 1 deals with the loan interest, okay? How is the loan interest going to be handled, and what kind of a loan interest the bank is going to be charging? That's what this one is about. So when it comes to the loan interest, you can do a level one, let's say it's gonna be 4% every year. You could do this and apply, and you see down here, the 4% is assumed to be the level interest the bank is gonna charge. However, we might be in a low interest environment, but maybe it's rising. So a common design is you show a low one, you know, starting 3% and then kind of increasing gradually. So this is a user input, as you see here, where the column is in the table in column 6. You can actually directly type in, and it is really not a whole lot of numbers to type. I mean, it's, you know, not really that hard to type it in. Okay, this is like 17 years of interest because year 18 the loan is going to be paid off. So that's one way. The other way, one more option in dealing with the loan interest is, first you need to get rid of all of the prior numbers showing up. These are incorrect for what I want to show. So I get rid of these by pushing the 0 and equal all the way down. So now I have everything to be 0. And what I want to show is basically a starting interest rate, which is low, and an ending interest rate, which is going to be in year 17. Okay, so I want to show right now is 3.25. Okay, then the last year of the interest is going to be year 17. Remember, the loan is paid off in year 18. So I would say it's going to rise to about 5%. Okay, so what you need to do is to make sure you're in year 17. Hold on for a minute. It's jumping. So make sure in year 17, I'm in the right cell of the right column. And in year 17, it's going to rise to 5. Okay, so from year 1 to year 17, this is the last of the interest rate, which is higher. First one is 3.25 in year 1. So I will use interpolate input, interpolate loan interest rate, and you need to be careful to make sure it's interpolated in the right year range. I am not interpolating from year 1 to year 57, rather 17, okay? So this is how you do the interpolate input. You enter the starting interest rate in year 1 and the last year of the loan's interest in year 17, and make sure these two input boxes are showing the correct years, and then you hit the apply button. These interests in the in-between years are going to be filled in for you by the program. So I click on apply. Okay, and I apply. You watch these numbers showing up. See here? See? So now I have these creeping up of an interest that's kind of calculated by the program instead of me hand typing, you know, kind of a rising of, I don't know, some basis point. Okay, so we took care of the interest rate input, all right? And then the next question is, how is the interest going to be paid? This is the interest due back to the bank every year. You either accrue it or you pay it, or you do some kind of a combination. Pay some, accrue some. Here, I am going to show it. The client is actually going to be paying this. We don't want to add these loan interests on top of the loan principal. It becomes an unsustainable arrangement. So here, I add the loan interest as pay loan interest, okay? Not accrue, none of these, but this one. So you see here in column 7, year 1, interest rate is 3.25 and your first loan is 234,075. And he is going to be paying $7,607, okay? So this is paying the loan interest based on the loan interest rate here. So this is the part that deals with the loan interest. Cash flow is referring to the policy cash flow, okay? And the policy cash flow, we saw the first one occurs in year 18, 1.7 million, and so forth. Then the later one starting year 23 at age 66 when he starts to retire, and so on. So these cash flow could be just including this first one. Could be his own spending money to go buy a boat, could be used to pay down the loan principal, okay? So you need to input the use of this policy cash flow, and I'm going to select this one. Remember, you're in this major tab and the cash flow side tab, okay? Directing the program what to do with the money coming out of the policy. So I picked this one because the first $1.7 million is supposed to be paying half of the loan back to the bank, okay? So loan repayment, any extra to the policy owner. So this is the one. So you see here, it's showing up in column 5 in year 18 as policy cash flow for loan repayment. So this is in the right column due to this input. And you see here in year 23 at age 66, the 361,000 cash flow from the policy is for retirement income. So these two columns are correctly input with the right numbers, okay? Because if you pick this input, cash flow for policy owner, if I pick this input, all of the money is going to be coming to this side. So this one will come to the column 4. Watch what happens. See? And this is incorrect. We want 1.7 million, the first withdrawal out of the policy, to be paid to the bank and not given to the policy owner. Therefore, you need to make sure you select the right input. And you see here, now it is all correct, okay? So we did the loan interest input, we did the cash flow input. The last one is about premium payments. And this one only is used if the policy owner, the insured, is going to come up with some kind of his own contribution to pay towards the premium. So it's this column that you can input the numbers. So if, for example, the client is going to pay 50,000 of the premium, and you see, it means he's going to borrow less money from the bank, okay? So this is what this input is. If your case is going to have the insurer borrow 100% of the premium, which is showing up as default, you don't even need to bother, doing any input here. This one is actually a simple one. So if your case is going to have the insurer borrow 100% of the premium, then just skip this. But make sure you do deal with these two input because these could be affecting the reports in a major way, okay? So we're done with this part here because I don't need to deal with the premium payment. He's not paying any money to the premium. He's borrowing 100% of the premium. He is paying the loan interest. Okay, so every year he is paying the loan interest. And cash flow, policy cash flow is split. Okay, first one is paid back to the bank right here. And later ones are paid to the insured, so he gets retirement spending money. Okay, last input is about loan reserve accounts. Okay, and remember, loan reserve accounts is only activated if you pick this input here, okay? So you make sure the first step is done, otherwise you won't be able to do anything here. If you don't get to use this part, if you see it all grayed out, come back to loan details and make sure these inputs are selected. I've already talked about this. Okay, so as you see here in column 7, first year's interest due to the bank is $7,600. And then in year 17, before the loan is paid back, at 5%, and the cumulative loan, it's going to rise to $175,000. So there's a huge difference between what the client needs to pay to the bank as, you know, loan interest payment. And most of the time, clients are used to a levelized commitment, annual commitment. What is he supposed to be putting aside? So the loan reserve accounts are basically created or used to show to the client, you need to put aside a levelized annual commitment. So in year 1, let's say you put aside 60,000, you pay 7,000 to the loan and then to the bank, and then you're going to have the rest of the money saved in an account earning an interest. So therefore, by year 17, you don't have to put up with 175 or 166 or whatever. Your annual levelized commitment is a level 60 or 70,000 to take care of the interest commitment. Okay, so this is what this loan reserve accounts are used for. You come here, you actually have 2 sinking funds illustrations that are available for you to use. So you need to check the boxes. If you uncheck it, it wouldn't, you know, be included in the report. So you check to include. The first one is a loan interest reserve account, and it is how much annualized, levelized commitment the client needs to put aside to take care of the annual interest payments over 17 years. So you say, include and average the cash flow needed by the policy owner for loan interest, okay? And because the bank loan is going to be paid off in year 18, I do the input from year 1 to year 17, okay? So this year range needs to kind of coincide with the year of the loan repayment. So that took care of this one, okay? Next, I also want to have an additional report that shows a Libra, which is loan interest and balance reserve account. And this is going to be showing to the client a levelized annual commitment of funds to put aside that will produce enough money to cover the annual interest as well as the loan principal repayment back to the bank. Okay, so again, you establish a year range. I do year 1 to year 17. Year 17 for 17 years, because after year 18 the loan is paid off. We don't need to, you know, we want the whole thing to be the plan to be executed and done. So that's why I established these kind of year range. And the money is going to be earning some kind of interest. So here you could do a tax exempt account earning, you know, 3%, 4%. Again, these are user choice and user input, okay? Here I am going to show some kind of an investment portfolio account, and it's earning a decent 8%, okay? And last input is rate of return. This one is actually very, very simple. You either include you don't want rate of return analysis showing up on the report. you don't want ROR numbers, then just not include it. But I think it's a really important number to include. Just include those. Check and check both gross rate of return, net rate of return. Okay, so now we're ready to see the reports. Okay, you come to report selection. For a new user, it's really a good idea to just add all available reports. And then later on, if you need to show less, you could just remove reports. Remove. And you can order the like summary. I want it to be one of the first reports to show up. So you can move it up. Okay, and this should be after the preface. And I want to move these down. And so on. Okay, so you can order these reports and then you can add a cover page over here. So report selection has these subtabs. You can change the color scheme. You can add a cover page. So I will do a cover page. This is for Jim Reed. Okay, premium financing, or can name this retirement premium financing. So that's the title. Okay, and so on. You can add a quote. You could leave it blank. Okay, and you can change your pictures and so forth. So I picked this one. Okay, so you need to make sure this box is green checked. Okay, even though you did the design of the cover page, if you forget to include, there's no cover page. So I add the include, and just up the report is just, you know, changing you can click on it and change the color scheme. Okay, so now back to select your reports. We're back to report selection. Now we can preview the reports. So the cover page, it comes with a nice preface talking about the pros and cons of this. So it's okay. Summary report is a key report. Okay, it shows premium and loan summary. Premium is this much, and premium borrowed from the bank. 100% of the premium is being borrowed. What is the interest rate, and how much is the annual dollar amount that you need, or the policy owner needs to pay back to the bank. Okay, so, and then the collateral, you see, total loan is basically 3.5 million, which is the cumulative premium. Okay, and you've got the cash value and death benefit, and you see here there's, you know, there's not enough cash value to secure the total loan for quite a number of years, okay, due to the cash value not being as high as the cumulative premium payment. So it shows up as an additional collateral. This column could be removed if you deselect the collateral input. Okay, this one will not be here, but it's good to add those. And you see here, column 5 is the cumulative annual interest cost. Over 17 years, he has to pay 1.5 million total to the bank as interest paid. And you see in year 18, there is going to be a repayment of the total loan, which is actually 3.5 million, right? It shows up here as cumulative premium. It shows up here, cumulative loan, 3.5, okay? So we are going to have 1.755 loans coming out of the policy. You see here, Net policy loan used to reduce the loan, bank loan. So policy loan used to pay back half of the bank loan. And you see here, loan repayment paid by policy owner. This is his own money. So he's going to be paying in year 18, $1.7 million. So the total loan is repayment is split between the policy distribution and his own out-of-pocket funds. Okay, and you have the loan repaid, and therefore there's no more ongoing interest costs, and he owns the policy free and clear. He gets the retirement income, and family gets this kind of death benefit protection. Okay, and it grows to be a nice big policy by age 100. Okay, so this is actually, it's kind of reducing because I guess due to the, cost of mortality as he gets older, but you still have a viable policy here. Okay, so that's the summary reports over 57 years. And then we got this, remember the Libra account and then the Lira account. This one is basically telling the client, if you need to put aside and levelize 118, almost 119,000 per year, earning 8% to take care of the loan repayment as well as the annual interest cost. So, okay, remember the premium is 237 or something. Okay, here he's coming up with 119 to take care of both the loan principal as well as the loan interest. Next one, the Lira. If he is going to just want to know what is his levelized annual commitment to take care of the interest payment, he needs to come up with about 70,800, put it into an account earning 8%, and you see every year is gonna withdraw this kind of money, which is going to be used to pay back to the bank. Okay, and the rest of the money. So you see year one, he comes up with 70,000, he pays 7,000, and then he has this kind of money left to work or earn 8% interest in the account, and so on. So this is a sinking fund report, okay? It's useful for those kind of scenarios. And then we have lots of other rate of return reports, which again is a user input. You check to include ROR report, then these reports get produced. If you uncheck that input box, these reports will not show up, okay? Policy loan analysis. So you see here, year 18. First distribution occurs, 1.77 to reduce the loan. Then this is retirement income. This is his spending money. Okay, and this one is comparison of premium financing versus pay. So it's going to be either him having the option to pay 100% of the premium instead of borrowing the money versus him borrowing the premium and then pay, some of the costs associated with the loan. Which one is a better option? Okay, this is what this side-by-side comparison is about. And it shows you out here 6.59 versus this. Okay, so this is the his out-of-pocket cost. You see here, the real cost is interest payment plus this half of the loan repayment. Okay, and he gets these kind of just retirement income is 5.4 million. Okay, and this is the source data, basic life insurance data from the insurance carrier. analysis of the bank loan, and so on. So there's a lot of these different reports that are, available and so forth. So this is basically the whole set of report. And you click on the done to save the case, and you got the workbook done.